I'm a little bit concerned. Recently, I put out a video about when to lock in your fixed rate or what you should do to figure out if you should be locking into a fixed rate. And quite frankly, the comments in the comment section had me quite concerned because we had a whole bunch of people putting things like, hey, what do you think of this 1.15% rate? Or what do you think about 1.15 versus 1.9 on a fixed? Or what do you think about this 1.6% variable rate I've been offered at my bank? And quite honestly, we had a lot of people talking about rate, which is probably the least important thing when it comes to choosing your mortgage, instead of talking about the things that matter, which are product, penalty, and price. So I'm concerned that people are choosing variable rate mortgages without taking into consideration some of the more important things. So today we're going to discuss that as well as an update from Mosh Milevsky, the king of the fixed versus variable rate study. The definitive guide on how to manage your credit, product, penalty, price, in that order. It's never been more important to get your mortgage right. Okay, so welcome back. I've been looking at the comments in some of my videos recently, and I think there's some cause for some concern because we see people making that big mistake, which is they're talking more about their rate rather than the product, the penalty, the price, or even the provider of the mortgage that they are getting. So today we're going to discuss why chasing rate is the least important thing you should do. In fact, it's probably one of the most dangerous things you can do, and what you need in order to make a proper decision when it comes to selecting your mortgage. But before we get into it, do me that favor, hit that subscribe button, hit that notification bell, and please hit that like button so more people like you can see this video. And don't forget about our race to 25,000 subscribers, where when we hit 25,000 subscribers, we're going to give away $5,000 to one lucky winner. And on top of all of that, if you're watching this video and you're one of those people who's put the interest rate that they are getting in the comments section without any details about the product or the penalty or the price, well, you need our Secrets to Getting the Lowest Interest Rate course, where we go through from start to finish how to get the best rate without stepping on any landmines or finding any surprises in your mortgage. I think it's hugely important that people start thinking more about the product that they're getting than the price that they're paying, and the price being the interest rate, because it doesn't always equate to the actual dollars that you're going to spend on the mortgage. So I highly recommend, if you're watching this video and you found yourself in a position where you're going, hey, I got 1.15%, but I don't actually know what that means, take that course. It costs like $99 right now. Plus, we'll give you a free 10 times your money back guarantee if you choose Mortgage 360 for your mortgage. So we'll give you $1,000. And ultimately, if that course saves you from making a really big mistake by choosing a discount mortgage or a mortgage where you don't understand what comes with the product that you're getting, well, I think it'll be well worth the very, very, very low entry price. You can go to ratesecrets.ca to get it, and we'll put a link in the description below as well. So let's get into it. Let's discuss how to choose your mortgage, proper product, proper penalty, proper price. Let's start first and foremost by jumping in, and I want to show you something really interesting. One of the commenters pointed out recently in the comment section that Mosh Milevsky, who wrote the study on fixed versus variable rates, which most mortgage brokers and bankers quote, and is the reason why a lot of people encourage you to select variable rate mortgages. Well, he put out a quote recently, a tweet recently that said, to be honest, that was 20 years ago. Today, I would probably go fixed with respect to his choice in mortgages. So I'll show you this tweet here. This is it. It's responding to a rates.ca fixed mortgage versus variable mortgage article. I took the opportunity to go in and ask him the question, why have your thoughts changed on this? And he came back very quickly with a reply, which I think is very important and very valid for people to look at. And that is, when facts change, I change my mind. One of the things that I think is important in business and finances is that you don't make a decision and then stick to your guns and, hold the decision that you made previously as the absolute right one, and therefore refuse to change your mind and make bad decisions in the future. So he's very much saying that based on the information that he has right now, he's probably more comfortable with fixed rate mortgages, which I think is cool. I think it's great that he's communicating this. And he said the reason why is inflation risk, elevated leverage, and greater need for financial stability. So I think these are all important. And I think what I really respect about Mosh Milevsky was after he did his original fixed versus float study, he came out and he put out another article that had to do with the most important thing is your client's risk factors. We've covered that in other videos. And really what it comes down to is variable versus fixed is very much a question of risk tolerance. It's the exact same question as Do you think you should be investing in stocks or bonds? Because bonds have very little risk, stocks have a lot of risk. And what is your risk tolerance and which are you choosing as a result? And then you figure out, based on the returns of the stocks, am I willing to take the risk? Or do I want to be more secure over here with my bonds and not get as many returns? Well, this is the same conversation we're having when it comes to variable versus fixed rates. It's what's the difference in the interest? What's the difference in the actual dollars that we're going to pay for that mortgage? And is that difference in dollars worth it for the security of having a fixed rate mortgage? So, that's all great. And a lot of people watch this channel and then they've gone on to talk to their own mortgage brokers or their own bankers and said, I want a variable rate, which kind of scares me because that doesn't give me the ability to protect them from rising interest rates and do the mortgage planning that we do, where we are able to take people and, if they've got a variable rate right now at 1.45, we can potentially move them into another variable rate at 0.99% on a 3-year mortgage. And we can save them a bunch of money as a result of having a strategy built around their variable rate mortgage. And then also we can instruct them on how to take the difference in the payments, put it aside. So in case interest rates do go up or go up more than we expect, they have money available to subsidize it. So my fear is that people are taking this variable rate strategy, they're not putting money aside, and they're just taking their lower payments, going and consuming with the rest of the money. And then when interest rates do start to go up, they aren't going to know what to do or when to do it. So a little bit concerned there. And then I'm also concerned with respect to the type of products that people are choosing, because when somebody comes to me and says, hey, I got offered 1.05 or 1.15% on my variable rate mortgage, I can tell you unequivocally that that is probably a discount mortgage, and it comes with some sort of limited feature, the inability to move to a different lender if interest rates go down or if you need to, or some other sort of factor that you probably don't realize is there. And one of the questions we got asked recently as well is, how do I know that my product is a discount mortgage versus not a discount mortgage? Is it disclosed somewhere? Well, yes, it's on the commitment letter, but in all likelihood, you probably have to know what to look for in order to be able to find it. So there's a whole bunch of things here where when somebody comes to Mortgage 360, I can say, okay, here's what the discount mortgage is. Here's what the mortgage that we recommend is. Here's the differences, and our clients make informed decisions. What I'm seeing a lot of people who take information from this channel and other channels doing is they're just going, oh, variable rate, I'm going to go get the lowest interest rate. And then they don't understand necessarily the product that they're getting themselves into. So I'm slightly concerned about that. And that's why this video, I want to talk about product, penalty, and price, because as you hear in the intro, every single time that you watch one of my videos, product, penalty, price in that order. It's never been more important to get your mortgage right. That was recorded over a year ago, and it is even more important today than it was back then. You need to make sure that you're getting the right product with the right mortgage and making sure that you aren't going to step on any landmines or have any surprises. And people think, oh, I'll just go to my bank, they'll take care of me. Well, there's a lot of landmines with banks. And people think, oh, well, I have this broker that I trust. I'll just go to him or her, and you never know exactly what they're selling you. So it's really, really important to get this right. So I want to give you a little bit more information on that. So what we're going to do is I'm going to throw up above my right shoulder here, the 3 things that you need to pay attention to when choosing a mortgage in 2022 and beyond. So first and foremost, the single most important decision you can make is getting the right product, right? So we had Robinson Smith the other day on from the Smith Maneuver. In order to do the Smith Maneuver, the number one thing you need to do is you need to get the right product. And by the way, the Smith Maneuver readvanceable mortgages are priced slightly higher than the rest of the mortgages in the industry. And the reason why is because they're a better product. They give you more opportunity. And as you saw in that Smith Maneuver video, it can increase your potential net worth by $500,000 over the next 25 years. So, is it really worth chasing 0.1% lower interest rates if you have the opportunity to save $500,000? Because 0.1% lower interest rate is probably a cup of coffee a week for most mortgages and most people. So just like anything else, mortgages, you get what you pay for, and the lower the price that you pay, the higher chance that you're going to have features and opportunities stripped away from you. So when you are getting your mortgage, you want to make sure that you have lots of flexibility. What that means is you want to choose low penalty lenders. If you're choosing a fixed rate mortgage, probably stay away from the 5 major banks because they have higher penalties. We have a client right now. She is at 2.79% on her big bank mortgage. The going rate is 2.79%. So therefore, In most cases, she should only have a 3-month interest penalty because the bank can lend out the money that she is paying off to a new borrower at exactly the same rate, but they have this little discount thing built in that ends up putting her in a position where instead of having a 3-month interest penalty of $1,500, she has an $8,000 penalty. So first and foremost, knowing what the penalties are is hugely important, and knowing that if you get a mortgage from an A-plus lender that is a monoline lender, so in other words, a lender that you've probably never heard of like First National, MCAP, or CMLS, you're probably going to end up getting a lower penalty and a better mortgage because those lenders have to have better products. If they didn't have better products than the big banks, they wouldn't exist, because why would you go to a company that you don't recognize when you can get the exact same mortgage at a bigger bank? The reality of it is if they're not a household name, they likely have a better product to begin with. And ultimately what that means for you is lower costs of borrowing over time. The other thing you need to watch out for is when you do go to your bank or you go to some of these monoline lenders, they have both their full featured mortgages and their discount mortgages. And their discount mortgages tend to come with things like bona fide sale clauses or higher penalties, flat fee penalties. And those are things that can come back and bite you somewhere down the road. So in other words, if you need the opportunity to refinance and you have a bona fide sale clause, which means you can't switch to a different lender or you can't get out of the mortgage unless you sell the property, well, that means that you can end up being stuck with that lender until the end of the term, which most people don't think is a big deal. But when you look at the fact that 60% of people don't make it to the end of their 5-year fixed term, it becomes a big issue for a pretty large number of people every year in Canada. Now, on top of that, just having the right prepayment privileges, having the right type of lender that is going to be willing to work with you, having the right features from a portability standpoint, they're all very, very, very important. So when you are selecting a mortgage, you shouldn't even be having a rate conversation until you have identified with your broker. And I'm going to call a spade here. The banks have one product. They're going to try to sell you that product. A broker can go through and talk about the differences between different products. What you should be doing is saying, tell me about all the different products you have, which one you would recommend for me, and why that product is better than the other products. And then once you've decided on the product, whether it's a First National full featured mortgage or an MCAP full featured mortgage, then you go, okay, well, what are the products that are similar to this and with different lenders and different organizations, and then which one has the best price? And then you pick the mortgage that is the product that you need, the product best suited for you, with the lender that has the price that is the best at that time on that particular product. That's how you do it. Product should come first. And then number 2 is you should be thinking about penalty. And you should always be thinking about penalty from the perspective of a 5-year fixed. Even if you're getting a variable rate mortgage right now, you should understand how your lender calculates their penalties on a 5-year fixed, because there's a chance that you may have to at some point lock into a 5-year fixed or a fixed rate mortgage of some sort. So in other words, big bank 5-year fixed mortgages have higher penalties than non-bank lenders. It's just the way it works, right? Typically, they have posted rates, they have the going rate. If you take the going rate, you get a discount. That discount gets added back into your mortgage if you go to pay the mortgage out prior to the end of your term. And that's an oversimplification of it. There's lots of videos on this channel where I talk about penalties specifically, but at the end of the day, you end up paying a higher penalty at a big bank. So if you choose a variable rate at a big bank in order to avoid the penalty, but you have to lock in at that big bank, you can end up having that penalty exposure down the road anyways. So what you ideally want to do is, if you're ever going to lock in at a big bank, you probably want to go, okay, well, I'm not going to lock in at the big bank. I'm going to have the flexibility to move to a different lender and therefore get a better rate and a lower penalty if I ever need to pay the mortgage out. But at the end of the day, if you can get a mortgage with a monoline lender, an A-plus lender like First National, MCAP, or CMLS, you should be taking it there, because if you do have to go and lock in, you're going to lock in, one, at better rates. You aren't going to have to negotiate off posted rate, but you're also going to lock into mortgages that typically have lower penalties. And then last but not least is the price. This is the last thing you should be worried about. So when you comment in the comment section below, what you shouldn't be saying is, hey, what do you think of a 1.15% variable rate versus this rate? What you should be saying is, hey, I've been considering this lender with this product, with this rate. And obviously it's irresponsible of me to give advice over the internet in a comment section on a YouTube video. I can really only legally and ethically give advice to my own clients. But at least if you get in the mindset of, hey, I'm getting this mortgage with this lender, it's this product, and then here's the price I'm paying for, that puts you in the right mindset of the value comparison and actually looking at value of the product versus looking at just the interest rate. Because here's the deal. We had a client today who they're in the process of closing on a refinance, or actually it's more of a switch transfer, which is industry term for switching from one lender to another. And that client said to Jessica, who works for me and does most of the mortgages that are my referral-based mortgages, this client said to her today, when I originally talked to Nolan 3 years ago, he said, we want to get you this type of mortgage with this type of lender. We're going to pay a little bit more, but what that's going to do is allow us to have the opportunity somewhere down the road to save a big chunk of money. And what he said to Jessica is he said, I thought that was just lip service and that it would never actually happen. And here I am today signing a commitment that's going to save me $8,000. Because here's the deal. Any broker, any banker can save you 0.1, 0.2%. But where a broker or a banker really earns their stripes is if they can make big changes, make big savings in lump sums like an $8,000 or a $10,000 change by making sure you had the right product to begin with. And, I look back and I think about, March of 2020 when all of the interest rates went from 2.7 down to 1.6%. And there was this reality that set in for a lot of people. And that was, there was two types of people that we couldn't help during that time get a lower interest rate and save a bunch of money. They were first and foremost people who had discount mortgages with things like bona fide sale clauses or flat fee penalties. And they were people who had big bank 5-year fixed mortgages with massive penalties. Because no matter what rate we were moving them to, their penalties were so big that there was no way that we would ever be able to save them out of that penalty hole. So when we're talking about mortgages, again, it is so important to think about first product, then 5-year fixed penalty, whether you're getting a variable or a fixed rate, and then think about the price. Don't be the fool who steps over dollars to chase pennies by trying to get 0.1 or 0.2% off of their interest rate. So I hope this video finds you well. I hope this information serves you well. And if you did find this video useful, do me that favor, hit that subscribe button, hit that notification bell. Please hit that like button so more people like you can see this video. Don't forget about that race to 25,000 subscribers. And if you've watched this and it's rung true and you're applying for a mortgage somewhere, feel free to apply with Mortgage 360. We'll take care of you. But make sure that you get that Secrets to Getting the Lowest Interest Rate course in order to make sure that you've got all the information you need to not step on one of those landmines or get a surprise 3 or 5 years down the road.